Okay, so you want to own an airline. You buy or lease a fleet of airplanes, paint your name on the tail, publish a schedule, and sell the same metal tube hundreds of times every week. A single aircraft can carry nearly 200 people from one city to another in the morning, turn around, carry another group back in the afternoon, and finish the day somewhere completely different. Every departure can generate tens of thousands of dollars in ticket revenue, and the aircraft can repeat the process for years. Unlike a factory, you do not have to manufacture a new product for every customer. You use the same seats again and again. It sounds like a hotel that moves, except the rooms can be sold several times in one day. Here's the problem. A hotel can sell an empty room tomorrow. An airline can never sell yesterday's empty seat. The moment the aircraft door closes, every unsold seat becomes permanently worthless. The flight still needs pilots, cabin crew, fuel, maintenance, airport access, baggage handling, insurance, and an airplane that may cost tens of millions of dollars to own or lease. Most of those costs do not disappear because seat 32A was empty, and even a completely full airplane can lose money if the passengers did not pay enough. That is the strange economics of owning an airline. You are not simply selling transportation. You are operating a network of disappearing inventory, where every seat has a deadline, and every delay can move aircraft, crews, and passengers into the wrong cities at the same time. Before we get into the numbers, we need to separate several businesses that all call themselves airlines. A full-service network carrier connects many cities through large hubs, sells premium cabins, carries corporate travelers, operates loyalty programs, and uses partner airlines to extend its reach.
A low-cost carrier tries to simplify the operation with fewer aircraft types, faster turnarounds, and more direct routes. An ultra-low-cost carrier advertises a very low base fare and charges separately for bags, seat selection, priority boarding, and other services. A regional airline may operate smaller aircraft for a larger brand under a capacity purchase agreement, receiving payment for flying the schedule while the major airline controls tickets and passengers. They all use airplanes, but they do not carry the same commercial risk. The business we are talking about is a scheduled passenger airline, because this is the version most people imagine when they think about owning a fleet and selling tickets to the public. The first thing you need is an airplane. You can buy one with cash, finance it with debt, lease it from an aircraft lessor, or buy it and immediately sell it to a lessor in a sale and leaseback transaction. Buying gives you an asset, but it requires enormous capital. Leasing reduces the amount of money needed up front and lets the airline expand faster, but it converts the aircraft into a fixed monthly obligation. The lease bill arrives whether the airplane flew 12 hours that day or never left the gate. A grounded aircraft may stop consuming fuel, but it still creates rent, insurance, parking, maintenance, and financing costs. The airplane only produces revenue while it is available, scheduled, and moving with paying passengers. The capital bill exists every day. A new narrow-body passenger aircraft can carry roughly 150 to more than 200 people, depending on the model and seating layout. But the aircraft itself is only the beginning. You need spare engines, tools, training, flight simulators, maintenance contracts, information systems, airport gates, check-in facilities, ground equipment, and enough cash to operate before ticket sales fully cover the network. An airline can grow its fleet faster than its balance sheet can safely support, especially when sale and leaseback transactions generate immediate cash. The company receives money today by selling the aircraft, then commits to years of rent. That can be useful when the airline is expanding and the aircraft remains productive. It becomes dangerous when demand falls or part of the fleet is grounded. The past cash is gone, but the future payments remain. Now suppose you have the aircraft and a route. Airline economics are usually measured through a unit called an available seat mile. If an airplane with 200 seats flies 1,000 miles, it creates 200,000 available seat miles. That is the capacity the airline offered for sale. If 160 seats are occupied by paying passengers, those passengers create 160,000 revenue passenger miles. Divide the second number by the first, and you get an 80% load factor. Load factor tells you how much of the physical capacity was used. It does not tell you whether the flight made money. To understand that, airlines compare revenue per available seat mile with cost per available seat mile. The abbreviations are often RASM and CASM. If the airline earns more revenue for each available seat mile than it spends, the operation can produce a margin. If cost exceeds revenue, a higher load factor may simply mean the airline is carrying more people through an unprofitable system. A full airplane is only profitable when the passengers paid enough to fill it. This is why ticket pricing looks irrational from the outside. Two people can sit beside each other on the same flight, receive the same physical transportation, and pay completely different prices. One booked months earlier during a sale. One booked 3 days before departure for a family emergency. One is flying on a corporate contract, one used miles, one paid for a flexible ticket.
The airline is not trying to assign one fair price to the seat. It is trying to maximize the total revenue of the cabin before the inventory expires. Revenue management systems divide seats into fare classes and estimate how much future demand may arrive. Selling the last cheap seat too early can block a business traveler willing to pay several times more. Refusing a cheap passenger while waiting for higher demand can leave the seat empty and produce nothing. The airline is constantly choosing between certain money now and possible money later. The deadline makes this different from ordinary retail. A store can keep an unsold product on the shelf. An airline cannot place Tuesday's empty seat in a warehouse and sell it on Friday. As departure approaches, the value of the seat can rise because urgent travelers have fewer alternatives, or collapse because the remaining demand never appears. This is also why airlines overbook. A percentage of customers cancel, change plans, miss connections, or simply do not arrive. If the airline sells exactly the physical number of seats, a flight that looked full in the reservation system can depart with empty chairs. The company therefore estimates the expected number of no-shows and may accept more reservations than the aircraft can hold. When the model is correct, everybody who arrives gets a seat, and the airline reduces wasted inventory. When more people arrive than expected, the airline must find volunteers, offer compensation, rebook passengers, or deny boarding under applicable rules. Overbooking is not mainly an attempt to sell one seat twice. It is an attempt to prevent a perishable product from expiring because the original buyer failed to use it. Now look at the cost side. Every flight needs 2 pilots on a typical narrow-body aircraft, several flight attendants, fuel, airport and navigation fees, maintenance support, ground handling, baggage systems, and an airworthy airplane. Some costs vary directly with the flight. Cancel the departure and you avoid much of the fuel burn, some landing fees, and some hourly maintenance. But many costs were committed long before departure. The aircraft lease still exists. Pilots and flight attendants still receive pay or guaranteed hours under labor agreements. The gate, information systems, training organization, headquarters, reservation platform, and insurance remain. Maintenance cannot be eliminated just because demand is weak. In fact, reducing the schedule can make unit costs rise because semi-fixed expenses are spread across fewer seat miles. This is one of the most dangerous airline effects. Management cuts capacity to reduce losses, but the remaining operation can become more expensive per seat because the network still carries much of the same infrastructure. Fuel is one of the largest and most volatile expenses. An airline cannot control crude oil prices, refinery margins, taxes, or local supply conditions. It can hedge part of future consumption with financial contracts, but hedging only changes the timing and distribution of risk. If prices rise beyond the protected volume, the airline still pays more. If prices fall, an unfavorable hedge can delay the benefit. More efficient aircraft reduce fuel burn, but they require purchase commitments or long-term leases. Older aircraft can be cheaper to acquire and easier to obtain, yet consume more fuel and often require more maintenance. Fleet planning is therefore a trade between capital cost, operating cost, reliability, and flexibility. The cheapest airplane to buy may be the most expensive to fly.
The most efficient airplane may become ruinous if a technical defect keeps it on the ground while the lease continues. Airlines also need their airplanes to work hard. Aircraft utilization measures how many hours per day an airplane spends in revenue service. A plane sitting at a gate is an expensive asset, producing nothing. Low-cost carriers often design quick turnarounds, so one aircraft can complete more flights each day. As soon as it lands, passengers exit, cleaners enter, bags are unloaded, fuel and catering are serviced, the next group boards, and the airplane leaves again. Reducing the turnaround by 20 minutes across several flights can create enough time for another daily segment without buying another aircraft. But the same efficiency removes slack. A maintenance delay early in the morning pushes the next flight back. Passengers miss connections. The crew approaches its legal duty time limit.
The airplane arrives late to the city where it was supposed to begin tomorrow's schedule. What looked like efficient utilization becomes a network recovery problem. An airline does not simply own aircraft. It must have the correct aircraft, qualified crew, gate, fuel, maintenance release, and passengers in the same place at the same time. A pilot trained for one aircraft type may not be able to operate another. A plane can be mechanically healthy but stranded in the wrong city. A replacement crew may exist but time out before the aircraft arrives. A spare airplane is valuable because it protects the schedule, but it is also an asset deliberately kept available instead of earning revenue. Operational resilience looks inefficient during a normal day and essential during a bad one. This becomes even more complicated in a hub-and-spoke network. A hub allows an airline to connect many city pairs without flying directly between every pair.
Passengers from several smaller cities arrive in waves, transfer through the hub, and depart toward many destinations. A route that looks weak by local traffic alone may be valuable because it feeds customers into long-haul or premium flights. The airline is not only pricing one segment, it is pricing an itinerary across the network. But a hub also concentrates risk. Weather in one city can delay hundreds of flights. A late feeder flight causes missed connections. The airline then needs new seats, hotel rooms, meal vouchers, baggage transfers, customer service staff, and aircraft repositioning. One thunderstorm can move thousands of passengers and dozens of crews away from the schedule planned for them. The network creates revenue by connecting flights, then creates cost when those connections break. Route planning is therefore not simply choosing cities people want to visit. The airline must decide what aircraft size, frequency, departure time, and price can support each market.
A larger aircraft usually offers a lower cost per seat because the same cockpit and much of the same infrastructure carry more passengers. But if the demand is not there, the extra seats become expiring inventory. A smaller aircraft matches demand better, but may have a higher cost per seat and fewer premium opportunities. Frequency matters too. Business travelers may pay more for a route with several daily departures because it gives them flexibility. One large daily flight can be cheaper to operate than 3 smaller flights, but less attractive to time-sensitive passengers. Airports add another layer. A congested airport may provide strong demand and high fares, but charge more for gates, landing, and facilities. Valuable takeoff and landing slots can limit growth. A secondary airport may be cheaper and easier to use, but farther from the passengers the airline wants. A route can be full and still weak because competition forces fares down. Another route can operate with a lower load factor and remain attractive because premium passengers, cargo, or connections produce more revenue per seat mile. This is why airlines do not simply chase the highest load factor. They chase the best relationship between price, capacity, and cost. The ticket itself is also only part of the revenue. A traditional network carrier earns money from premium cabins, baggage, cargo, change products, loyalty partnerships, lounge access, and corporate contracts. An ultra-low-cost airline separates the trip into pieces. The advertised fare buys transportation and very little else. A carry-on bag, checked bag, assigned seat, priority boarding, snack, or flexible change option becomes a separate product. This allows the airline to display an extremely low entry price while collecting more from passengers who value convenience. It can also make the base fare appear weaker than the actual customer revenue.
Spirit Airlines became one of the clearest examples of this model. For years, Spirit offered very low fares, fitted aircraft with dense seating, focused on price-sensitive leisure markets, and generated a large share of customer revenue outside the ticket itself. The model was not irrational. A low fare stimulated demand, while optional charges allowed each passenger to reveal what additional services they valued. A traveler carrying only a small personal item could pay very little. Another traveler on the same flight might pay for 2 bags, a larger seat, and priority boarding. The airplane was the same, but the revenue per passenger changed. The model also pushed larger airlines to introduce their own stripped-down basic economy products. Spirit proved that cheap transportation could create a large market. But cheap transportation only works if the airline remains structurally cheaper than the competitors responding to it. Spirit's fleet strategy initially supported that goal.
It operated Airbus narrow-body aircraft, allowing pilots, mechanics, parts, and training to be concentrated around one aircraft family. Dense seating increased available seat miles from each departure. High utilization spread ownership cost across more flights. Separate fees increased revenue without raising the headline fare. When demand was strong, aircraft were available, and costs remained controlled, the system could produce compelling economics. Then, several parts of the equation turned at once. After the pandemic, leisure demand returned strongly, but airlines added capacity into many of the same price-sensitive markets. More seats competed for the same customers. Fares came under pressure. Labor, maintenance, and other operating costs rose. Large network airlines used basic economy fares to compete for travelers who might once have chosen Spirit automatically. Spirit could fill many seats, but filling seats was no longer enough. The relationship between total revenue per available seat mile and total cost per available seat mile became the problem. In 2024, Spirit generated roughly $4.9 billion in operating revenue and recorded an operating loss of about $1.1 billion. Its net loss was more than $1.2 billion. The airline was not empty. It carried millions of passenger segments and operated hundreds of aircraft. The revenue was real. The cost structure was larger. At the same time, a manufacturing problem hit one of the most productive parts of the fleet. Pratt & Whitney's geared turbofan engines required accelerated inspections and removals because of a powder metal issue affecting certain components. For Spirit, this meant aircraft that should have been flying instead remained grounded while engines waited for inspection, repair, replacement, or available shop capacity. The airline received and negotiated compensation, but compensation did not fully recreate the network value of an available aircraft. A grounded plane produced no seat miles. Yet the lease, much of the labor organization, airport infrastructure, and overhead remained. Replacement capacity was not simple because aircraft and engines were constrained across the industry. By 2025, Spirit said its capacity had fallen by nearly 1/4 from the previous year, driven partly by the engine problem, grounded aircraft held for sale, and broader network restructuring. Its average daily aircraft utilization fell from just under 10 hours to around 7.7. That matters because rent and ownership costs were now spread across fewer flying hours. Spirit reported that adjusted cost per available seat mile, excluding fuel, rose from just under 8 cents to more than 9 cents.
Revenue per available seat mile improved slightly, but total cost per available seat mile still exceeded total revenue per available seat mile. The airline had fewer seats to sell, but the semi-fixed system surrounding those seats did not shrink at the same speed. Spirit was also relying on a proposed merger with JetBlue Airways as a strategic exit. The deal promised to combine the carriers, remove a competitor, and give Spirit's shareholders a cash value that the independent company might struggle to create. But in January of 2024, a federal judge blocked the merger after the Department of Justice argued that eliminating Spirit would reduce competition and remove an important low-fare option. JetBlue and Spirit later terminated the agreement. From the perspective of passengers, the ruling protected an independent discount competitor. From the perspective of Spirit's capital structure, the expected rescue disappeared while the operating problems remained.
The company still had aircraft commitments, leases, debt, labor, engine disruptions, and a network producing inadequate returns. In November of 2024, Spirit entered Chapter 11 bankruptcy protection. The restructuring removed debt, canceled the old equity, and created a new parent company. It emerged in March of 2025. On paper, this was the moment the balance sheet received another chance. But bankruptcy can reduce financial claims. It cannot automatically repair route economics, restore engines, raise fares, or make semi-fixed operating costs disappear. During 2025, Spirit's load factor was about 78.4%. Its total revenue per available seat mile was about 9.51 cents. Its total cost per available seat mile was about 11.43 cents. The gap was not an abstract accounting problem. For every unit of capacity produced across the system, the airline was spending more than it earned. Carrying more passengers through the same relationship did not solve it. Spirit's annual filings separated the year because of fresh start accounting, but the pre-emergence and post-emergence periods together contained operating losses of more than $760 million. The airline paid hundreds of millions in aircraft rent and aircraft debt service during the year, even as capacity declined. It began rejecting aircraft leases through the bankruptcy process and reduced the reported fleet from more than 200 aircraft at the end of 2024 to 131 at the end of 2025, excluding dozens of rejected aircraft. The company was trying to shrink into a size its revenue could support, but shrinking an airline is not like closing several identical stores. Routes support one another. Fewer aircraft mean fewer departure options, which can reduce convenience and weaken demand. A smaller schedule spreads technology, training, headquarters, airport, and loyalty costs across less capacity. Returning aircraft reduces future rent but can create lease rejection claims, return condition disputes, and operational gaps. Cutting employees saves cash but removes experience needed to run the remaining schedule reliably. Every attempt to reduce the system can make the remaining product less valuable. In August of 2025, less than 6 months after emerging from the first restructuring, Spirit filed for Chapter 11 again. It continued operating while negotiating with lenders, lessors, engine providers, and labor groups. The company rejected leases connected with dozens of aircraft and pursued additional financing. The physical airline was still visible. Passengers continued boarding yellow aircraft, crews continued working, tickets continued being sold. But the commercial machine was being dismantled around them. On May 2nd of 2026, Spirit began an orderly wind-down of operations. All flights were canceled and customer service ceased. The airline that had helped define ultra-low-cost flying in the United States did not run out of passengers or airplanes. It ran out of a profitable way to connect them. That is the central lesson of airline ownership. Demand for cheap flights can be enormous and still fail to support the cost of providing them. A low fare is not an advantage if competitors can match it. A young aircraft is not productive if its engine is unavailable. A high load factor is not success if unit revenue remains below unit cost. A bankruptcy can remove yesterday's debt without creating tomorrow's margin. And an aircraft that once looked like a flexible global asset can become a fixed claim held by a lessor who wants payment or the plane back. Spirit's collapse proves the disappearing inventory problem at scale. The company could not pause the weakest months and store the capacity for later. Every day it operated, seats departed and expired. Every day it did not operate, aircraft and labor still created claims. The business had to make hundreds of individual departures work while also supporting a network, fleet, and balance sheet built years earlier. Once that relationship broke, flying more could consume cash, and flying less could raise unit cost. There was no simple volume solution. After that case, there is only one additional layer needed to understand why the strongest airlines can produce very different results from the weakest ones. Some of the most valuable airline revenue is no longer created inside the airplane. It is created when customers use credit cards on the ground. Large airlines sell miles to banks that issue co-branded credit cards. The bank pays the airline when customers spend on the card. The customer earns miles. Those miles can later be redeemed for flights, upgrades, or other rewards. This gives the airline cash before the award travel occurs. Delta Airlines reported more than $8 billion of remuneration from American Express in 2025. That amount does not mean $8 billion of pure profit, and the loyalty program creates future redemption obligations. But it demonstrates how far the economics can move beyond the ticket. The airline has created a currency that customers value because the flight network makes it useful. The bank buys access to that loyalty. The airplane creates the loyalty currency, and the credit card helps finance the airplane. This is a major strategic difference. A weak airline depends heavily on the spread between what passengers pay and what flights cost. A strong network airline can combine ticket revenue with premium cabins, cargo, maintenance services, lounges, corporate contracts, and a large loyalty ecosystem. The flight still matters because miles are worthless without desirable destinations and available seats. But the relationship with the customer can generate money even during weeks when that customer does not travel. This does not remove airline cyclicality. Loyalty revenue can weaken if the brand deteriorates or the network becomes less useful. Award obligations have to be managed. Banks can renegotiate contracts. But diversified revenue gives the airline more ways to survive a period when ordinary fares are under pressure. It turns the airline from a pure transportation operator into part travel network, part data platform, and part financial marketing company. So, if you do decide to own an airline, understand what you are actually buying.
You are not buying airplanes that automatically create money every time they take off. You are buying a schedule that must place aircraft, crews, gates, maintenance, fuel, and passengers in the correct cities every day. You are buying inventory that vanishes at departure, a pricing system that must decide what every seat is worth before it expires, and a network where one delayed aircraft can create costs far beyond the original flight. You are buying fuel exposure, labor agreements, airport access, lease obligations, maintenance risk, and customer promises that survive after the fare has been collected. A full cabin can lose money. A grounded aircraft can keep charging rent. A cheap ticket can create demand while destroying margin. The strongest airline is not necessarily the one with the newest planes or the highest load factor.
It is the one that can earn more from every unit of capacity than the entire system costs to produce, while keeping enough operational resilience that one storm, engine problem, or market shift does not break the network. You are not buying airplanes. You are buying the ability to sell the same disappearing seat inventory at thousands of different prices before the doors close, and to rebuild that entire commercial machine again for the next departure. If you want more breakdowns of what expensive businesses really earn behind the scenes, subscribe to Money Anatomy.